Hey there, everybody. Welcome back to the Finding Financial Fitness Show. I'm your host, Nino Gonzalez, joined by my co-host today, Pei Chen, and we have a special guest, Adam Pugmire with CMG Home Loans. So we've been talking in previous episodes about tools that Pei and I and other investors have used to enhance our financial journey, kind of make it a little bit better. And we use those tools, and then we come up with those strategies to use those tools to make more money, to live a better lifestyle, right? And Adam was one of the first people that I personally actually met when I got into the investment world, learning about mortgages and this concept called the all-in-one, which to me at the time was very novel. And as I mentioned, I had a really good experience with learning because I didn't know anything. So it was for me a good learning opportunity to see, okay, well, I had a traditional mortgage. My interest rate was pretty good, and I was looking at buying another investment property on top of my primary residence. So I met with Adam, kind of got a little rundown, and since then I ended up purchasing an investment property with my all-in-one. And ever since then, I just want to buy all of my homes with the all-in-one product because of the product itself, but also two, because of Adam and his team at CMG for the education that they're willing to provide. So I wanted to bring him on to share that with the group, share that with all of our listeners, and dive deeper into it. So Adam, welcome. How you doing?
Thank you, man. Appreciate it. Doing great. Thanks for having me on here. You know, the all-in-one is, I think, as you can tell from your experience with me, the all-in-one is something I'm pretty passionate about. I got introduced to the loan, I don't even know, now 7-8 years ago. And the first loan that I did on the all-in-one, I got a text message from the client 6 months later, and he said, "Man, this loan is amazing." And it was like a light bulb went off in my head because I'd never had a client ever text me and tell me their mortgage was awesome before. And so that was pretty significant. Actually, it was kind of a pivotal time for me. It's what kind of triggered me to get licensed in basically the majority of the United States. I'm licensed in all states, with the exception of New York and Utah, which are in process right now. And it really has kind of allowed me to not only use it personally to offset my interest and reduce my balance and use my cash flow, or use my equity for cash flow. It's allowed me to meet folks like you where they've used this tool to dramatically improve their personal financial situation and their investment strategies, because it goes so hand in hand with so many different strategies, whether it's real estate related or life policy related with IBC concepts. You know, it allows you to really take the loan to the next level, potentially, and your finances to the next level. But, you know, I talk to people commonly, and I start the conversation with, look, my goal is actually not to talk you into the all-in-one. My goal is really just to kind of present to you the information about the all-in-one to determine if it's a good fit. And I don't perceive that spending time with someone to walk them through it to find out that it's not a good fit is a waste of time. And the reason why I think that is because at some point in time, the all-in-one is likely the best loan for them, maybe just not right now. And so that's kind of my approach is, let's just present the information, see if it's a good fit. And if it's not, it will be eventually. And so it's never waste the time to kind of do a consultation and a one-on-one review of someone's specifics. But essentially, what is the all-in-one, right? That's kind of the real deal, right? So the all-in-one is a first position home equity line of credit that's tied to and integrated to a sweep account. So what it allows you to do is it allows you to offset your interest with your cash flow. So as cash flow enters your checking account, for instance, I'll just go with the basic W-2 borrower, for instance, automatic payroll hits the checking account, and at midnight or 11:59, the money that is deposited into the account automatically sweeps the checking account to zero, shuffles that balance to the mortgage, and drops the balance of the mortgage by the equivalent amount. Now, that might sound scary to someone having a checking account at zero, but with the traditional setup, it allows you to reverse sweep as well. So when you make an expense, let's say you pay off an American Express, $2,000, you know, your monthly spending that you pay off a card at the end of the month, that money automatically reverse sweeps as well. So if you were to log into a checking account, for instance, it would say minus $2,000, which would look scary. It looked like an overdraft in a traditional environment. But really all it's doing is telling the mortgage, hey, we need $2,000 to make this transaction whole by the end of the night tonight. And then what happens is the checking account then sweeps back to zero, and the mortgage would increase by the $2,000. But what it did essentially is it allowed you to capitalize not on the money that you save, but it allows you to capitalize on the money you spend. So in that situation, the expenses that were charged on a credit card, while that money was waiting to be spent to pay the credit card bill, it sat in the form of a reduced balance, which reduced interest, and it allows you kind of to earn compound interest in reverse to yourself, essentially. And there are some nuances specifically in Texas for primary residences only to basically comply with state law. So there are a little bit nuances there. So for instance, the all-in-one in everywhere else in America is a 30-year drop period. And in Texas specifically, it's a 25-year drop period. And then whatever your remaining balance is, amortizes for the last 5 years. I haven't been doing it long enough to see anybody get to that point, but that's essentially how that's structured. And it doesn't have the same zero sweep strategy. So the line of credit is actually tied to the HELOC rather than a checking account. So there's a little bit more of a manual application specifically for Texas homestead. If you have a Texas rental property, the same rules apply to the rest of America as far as how the rules apply. It's tied to the sweep account.
Super interesting, because I think there's a lot of misinformation out there, or misunderstanding, I want to say, about the all-in-one product, including myself, because it's so different. It is just nothing anyone has ever heard of.
Sure.
Even for myself, when I was first learning about it, I had thought that it was just like a traditional HELOC on top of your traditional mortgage and then connected to a checking account. So I had a hard time in the beginning to wrap my head around, why would I refinance my 3.5% mortgage into this higher interest rate? I was still off the interest rate mindset. I was understanding how what you were describing about the sweeping of the money into the account, reducing the balance you owe. So if you want to touch on that a little bit, and you actually answered also one of my other questions, which was, is this available in all 50 states? So apparently it soon will be, right?
Yeah, there are a few nuances, like, in New York, the loan to value limit is 5% lower. So there's a couple states that have some slight nuances that relates to the loan to value, but the actual structure of the loan is the same in all the other states. To your point about why would I refinance a 3.5 rate, potentially go into a rate that's 8, and that decision actually needs to be evaluated closely. Now, initially you would go, why? There's no chance. The initial response would be, there's no chance where going from a 3.5 to an 8% rate would make any sense. That's actually not the scenario. And that's just because, for instance, if somebody's at 3.5 and their monthly cash flow is limited, or their paycheck to paycheck, stepping into an all-in-one with a higher rate, all you've really done is you've created an increased exposure to a higher rate on your balance. You really haven't done anything to improve yourself. But if for someone who has good cash flow or has leftover money at the end of the calendar month, that 3.5 could potentially be less than 1% effective interest rate, even with an 8% rate, because of the way interest calculates. And I'll give you an example. This is kind of an extreme example, but it kind of helps the math to be understood a little bit. If someone has a $200,000 balance and and let's just say they have a $100,000 loan balance and they have a $100,000 home equity line of credit, to start with, the 3.5 rate on the first really isn't 3.5, because your second mortgage is bringing up your effective rate. You have basically a blended rate. So let's just say it was 4% on the first for easy math and 10% on a home equity line of credit. You're really at 14%. And if each are at $100,000, your effective rate is 7 anyways, right? Your blended rate. So in that situation, okay, now we're not really bridging the gap from 3.5 to 8. It's 7 to 8. And the way the interest calculates on the all-in-one makes the all-in-one a no-brainer in that scenario, if there's any cash flow whatsoever. And typically, I would say somewhere in the range of 10% left over at the end of a calendar month. If someone has 10% or more, it's something to consider. It's not as necessarily a no-brainer at 10%, but it's definitely something to consider once you have 10% or more.
Do you find in your practice that people they tend to have hidden money?
Oh, 100%.
They tell you, I only have
100%.
But they actually have, $1,500 or something.
I'll ask people what they have in liquid assets, as far as checking and savings and low yield, and they'll mention that they have the $3,000 to $5,000 in their checking account, they have $10,000 or $15,000 in their savings. And then after talking to them for an hour, I discover that they have $100,000 in a money market account that they didn't identify as checking and savings. And that's a great example too, because there's a lot of folks out there that have a ton of money sitting in a money market account, and which is way better than obviously have it sitting in just regular traditional checking or savings. But at the end of the day, the best I've seen is 5.25% on a money market account. Most of them are between 4 and 5%. But good example, if somebody has $100,000 in a money market account at 5%, they're going to earn $5,000 on that money. But that's before taxes.
Yep.
So whatever their tax bracket, if you've got a high income earner that's at 45% in taxes, they're going to pay 40% of that in tax. So they might walk away with $2,500 or $3,000 of the $5,000 gain because of the earnings. Now, the way the all-in-one works, if you take that $100,000, if you have $100,000 worth of debt on the mortgage, you can park that against the debt, still have the peace of mind to access it, which is really the main reason why people build up savings a lot of times is like, hey, I don't really have need for this. I just like the peace of mind knowing it's there, or the 1-year emergency plan or whatever. Everyone's a little bit different on how they do stuff. But if you put the money against the all-in-one and you're offsetting debt, that's not classified as earnings, it's classified as savings. So there is no tax implication. So, I've seen situations where someone has $100,000 or $250,000 in low yield returns, even bonds, for instance. A lot of times bonds are actually ignored. They think of that as their investment portfolio. And those bonds are the same situation. It's taxable income when they go to take that money out. If they take that same money and offset their interest with their cash, there's no taxable implication. So your rate of return can actually be doubled, right? So instead of getting $2,500, $100,000 at 8% is $8,000, right? So you can double and triple your rate of return for the exact same dollars and still have the same security, because it's not like you're putting the money in the market where the market might swing 50%. There's no chance that the market swings 50% or at all. So you have a guaranteed rate of return of whatever your interest is. You'll save that and begin, because it's not classified as earnings, it's tax-free.
And that's
same goes with the IBC policies. A lot of the people that we know that have, this only works with all-in-one, to be honest, right?
Yeah.
If you just dump all your money into your mortgage, you won't have access to it unless you do a HELOC, application and get that. But like with the all-in-one, you literally can take your cash value, borrow that, pay down your all-in-one, and have access to that money. And it's
Pei, I'll give you an example on that. And I tell people this all the time that have IBC policies. So again, I like to use the round numbers. Somebody has $100,000 available cash equity in a IBC, and they have an all-in-one that's simple interest at 8% or whatever, right? Well, if they can borrow from the IBC at 4 or 5, essentially they can pull that out and make the spread. So it's an instant arbitrage between those figures while still allowing the IBC policy to grow, right? So the advantage to be able to do that is huge. So, and then if there's a need to put money back into the policy for any reason, you just pull right directly from the all-in-one again, and you can feed the needs of whatever the policy needs. And the reason why I particularly like that isn't necessarily even just the interest rate, because that's obviously a significant advantage. Even if the interest rates were the same, there's obviously multiple places to go, right? Going to you obviously is a great solution. Obviously, that's what we're going for, right? Is people to use you for life policies, and Michael. But the idea is, even if it was the exact same rate, because it's a regular checking account, the movement of the money is completely simple, right? It's wire transfers and debit cards and checkbook completely tied, because it's a fully integrated checking account, where the IBC concept is a little bit more of a hacked concept, right? It's like we're hacking the system that's built, and we're finding this amazing tool to use it. So the all-in-one allows you to kind of blend the concepts together and have the spending and the movement of the money be completely seamless, the way that you're already accustomed to doing it.
It's almost like those, there are people out there that take their policy and they go and get a insurance-backed line of credit.
Yep.
It's kind of like that, but except this one, you actually can have full access to your value by just doing that, because you have full control of your IBC. You can take out max loan and pay down your all-in-one and get on with your life. Borrow that money out and keep on doing your investment. It's a seamless. I love it. I just, as soon as I can qualify, believe me.
Yeah. Yeah. And I
Well,
think
let's talk about that. The qualifications. I think that's something that I think right now, the way you're talking about it, this is just, I remember you said this in the first 5 minutes of you and I speaking, and I was like, sign me up. I was like, let's go. How do I get this? I know the value in it, especially if you have equity in your home. We talk about the 3.5% rate versus the 8%, but the 3.5% rate, if you're sitting on $100K in equity, that's unused money. So you're actually losing money because of what you could be making, the opportunity cost of that same money. So the calculators don't even factor that in if you factor in a correct rate of return of what you could be getting for the opportunity cost. So given most people are probably like Pei right now, myself listening, we're like, this is great. All right, like, how do I do this? How can I qualify? What's the kind of the breakdown of what you're looking for and the requirements to get in?
Yeah. So I'm going to back up real quick on that concept right there. I talked to a real estate agent a couple of years ago, and he was doing 4 or 5 flips a year on real estate transactions, buy a house, fix it up, sell it. And he was doing hard money. He was borrowing hard money. And he had, on his situation, he had like $600,000-700,000 available equity in this home, but his interest rate was like, I don't even remember what it was, but it was like the lowest I'd ever seen. It was like 1.875 on a 15-year mortgage, right? And so in his mind, he's like, I'm never getting rid of that. And I was like, well, think about this. You're doing 4 or 5 flips a year at hard money with closing costs. So you're paying $20,000 to $25,000 a year in fees to do your flips. Now, they justify themselves because he's making a profit on the transaction. But is that 1.875% really saving you money when you could utilize that same account with an all-in-one and self-fund your flips and eliminate that $25,000? He's not currently saving $25,000 a year in interest on that 1.875. It's saving him a few grand a year, right? So in his situation, it'd been about a $20,000 flip a $20,000 gain per year to utilize the all-in-one. So ditching the 1.875 actually pencils in that situation. So because a lot of times people at the outset, when they see little videos or things like that on YouTube or Instagram, the comment sections are like, that's the stupidest thing I've ever heard of, right? And it can be. It's not a one size fits all, but man, there's a lot of situations where you're tricked into the idea that the 30-year fix or the 15-year fix is the best solution, and they're really not. Now, back to your question about the qualification. So you can do an all-in-one on a 1 to 4 unit property, residential. You can do it as a purchase. You can do it as a refinance. You can do it as a primary residence. You can do it as a secondary residence, and you can do it on investment properties. So it kind of covers everything that the traditional mortgage covers: 1 to 4 unit, primary, secondary, or investment properties. Minimum credit score for primary and second homes is 700. Investment properties, minimum credit score is 720. On a purchase, you have to have a minimum on a primary residence of 10%. 20, the math works a lot better when you have 20% down. Because the all-in-one has mortgage insurance, and it's not monthly like a traditional loan, it's upfront. So it's a lot of times doesn't pencil the best unless you have 20% down. On an investment property, you have to have 25% down on the purchase. And if you're doing cash out, that's one of the benefits of the all-in-one. There's not a lot of great places to get a line of credit on an investment property at all. The all-in-one allows you to do up to 70% cash out on an investment property. So a lot of people are sitting on a bunch of equity from a property they bought 4 or 5 years ago. Properties increased in value, they've paid down the balance, and now they're left with like, I really don't want to sell the property, but it would be nice to get access to this line of credit. The all-in-one's a great vehicle for that because it allows you to tap into equity of an investment property without selling it. So that's kind of the rough qualifications. Obviously, the higher the credit score, the lower the cost for interest rates and things like that. You do also have to have a minimum of 10% in reserves. So if somebody does a $500,000 line of credit, they have to have 50 grand somewhere. We're not collateralizing that money, but it's required to kind of show, hey, if life throws me a curveball, I have the ability to access some cash to handle that curveball. So again, no collateralization of that money, but you do have to demonstrate a minimum of 10% reserves. If your debt to income ratio is a little bit higher, that reserve requirement jumps to 15%. But, IRAs, 401ks, all that kind of money can count as long as it's accessible. Some investment plans don't allow you to tap into your money at all until retirement age. In those situations, that wouldn't be considered reserves. But any checking, savings, 401k, trading accounts, Charles Schwab accounts, all that kind of stuff would be eligible as reserves. So that's kind of the qualifications, the rough qualifications anyways.
So quick question on that.
Yeah.
One point about the 20% and 25% for the investment properties.
Yeah.
So what if I bought a property, I didn't put a lot of money down, but now the market has got up and now the property, can it be based on a new appraisal?
Great question. Yeah, it's 100% based off new appraisal. So if you're pulling, in that situation, you'd be pulling cash out. And even if you weren't going to pull cash out, but your line of credit was significantly higher than what you currently owed, that would be considered cash out, the ability to borrow from it. Anytime that you're doing cash out, the only time you can use the value is if you've been on title for 6 months, if you're going cash out. So, but yeah, we'll use the appraised value to determine the loan value, even if it isn't 6 months, but you can't do cash out until 6 months on title. But let's just say, for instance, you bought a home for $200 yesterday. You bought it for $200. You did 100% financing because you had a family member that was willing to do it. You could do it if the property was worth, let's say you bought it 25% under market value, right? So if the loan that you're trying to refinance is 75% of the actual value, you could actually do a rate and term refinance using the appraised value, which might be 250 or 270 or whatever the situation is, and cash out, essentially rate and term refinance that first. And now you've replaced the loan completely. You could do that and use the value 1 day after purchase technically. But to do technically cash out, you'd have to be 6 months on title. The guidelines on the all-in-one are 40 something pages long, and those are specific to the all-in-one. And when the all-in-one guidelines don't directly address a specific guideline, the loan defaults to what Fannie Mae's rules are, right? So then Fannie Mae's rules are hundreds of pages deep, right? So I always find that can't get too confident in decisions, because as soon as you think you've seen it all, you'll see some sort of crazy situation that requires you to dig a little bit deeper into the guidelines. But yeah, so we default to Fannie Mae rules if it's not specifically outlined in the all-in-one.
Yeah, we had the challenges, and that was partially, I think, because my husband had just started, we exited the W-2 world.
Yeah.
We planning and thinking about it. We should have obviously done the loan before we quit. But,
it's actually a great point. There's a lot of people that they're very confident in their ability to make money when they transition from W-2 to self-employment. And they don't think about the consequences that come with financing, because most mortgages require you to have a 2-year history of self-employment. And man, I would recommend anyone that thinks they might need access to cash to line out their loan needs in advance of making the move to self-employment, because they could save themselves a lot of heartache down the road for sure. Oh, yeah. The best time to borrow is when you don't need it, right?
Nope.
When you need it, it's tough to get your hands on it sometimes. So lining it out in advance is advisable in a lot of situations.
I have learned, this last year I bought another property and I had to go with DSCR, pretty much not where I wanted to go, but it's not easy when you don't have the proper documentation for these type of loans. But so just watch out for listeners who are thinking about it. Speaking from experience, if I have a time machine, what would I do differently when I left my job?
Sure.
So I think tying in with that, going into strategy-wise about just the all-in-one in general, now we know, okay, just time it correctly because I know we have people on this show that are listeners that are listening from all areas of investment strategies, whether they're barely starting out in their investment journey or are ready to quit their W-2 job. I think that's why we wanted to have you on so early on, because we want people to implement this strategy as soon as possible and essentially stack the strategies, which led me to my next question about multiple all-in-ones, right? If it works for my primary residence, and then I do it on my primary, and then my primary residence, I have equity built up in that home, but then I want to use the equity in that home to then go buy a rental property to bring in more investment income. Can I have multiple all-in-ones? And if so, what's the maximum that I can have?
Yeah, so you potentially can have up to 4, technically: primary residence, second home, and potentially up to 2 investment properties. Okay. There's not a lot of situations where 4 would make sense. Very few. In fact, I would say that for the majority of folks, more than 1 is maybe too much, right? But there are situations where, let's just say you've got the husband, wife, engineer, school teacher combo, and they manage all of their money completely separate from maybe the 3 or 4 or 5 rentals they have. Having it all in one of the primary residence, allowing them to maximize the efficiency of the cash flow that's flowing for their personal income, and then separately managing the investment properties, flowing all of the cash flow from all properties through one all-in-one associated with the rental property would be a perfect, a lot of times, opportunity or reason to have a second one, because it allows you to maximize the efficiency of both streams of cash flow separately from one another, while also maximize the efficiency of the stream of that cash flow itself.
Gotcha. So, which kind of brings me to a point about multiple ownership. So if I get the primary residence all in one of my primary residence, and I know that this is a very hot topic right now, using LLCs to buy rental properties, right? And I know we can agree on or disagree on this because there are some things that are kind of incorrectly spewed out about needing an LLC for every single entity that you're going to go buy a property with. But if I wanted to go buy a property, an investment property, can I do an all-in-one under my LLC?
Technically, no. It would have to be in the name of a trust or your personal name. So you could do it in the name of a trust or your personal name, but not an LLC. You can't close it in the name of an LLC. So if you have a property that's currently in an LLC, you could transfer title to yourself and proceed with the refinance. We're definitely not advised to have you transfer back into the LLC. Right. That's not something that we would advise on. But yeah, you can transfer from the LLC into your personal name and then proceed with the refinance.
So what if I have a property that's maybe almost paid off, completely paid off, and I still do an all-in-one?
Yeah, great. So free and clear properties technically require an exception if they're free and clear. And typically speaking, there's a minimum draw amount of $100,000 sometimes the total loan amount might not be $100,000. So that's where we can get a little bit of wiggle room there. But if let's say you had a $500,000 property free and clear, you could potentially on a primary residence do $400,000 as a line of credit, but they're not going to allow you to do it unless there's a need for the money, right? What they don't want you to do is draw $100,000 minimum requirement, throw the $100,000 right back in and go zero balance, because there's costs associated with generating the loan, so there's no revenue at all if it's just created and instantly brought to zero. So the situation where you see folks doing that free clear property is maybe they do a consolidation. Maybe they take their more expensive property and they consolidate and pay off 2 or 3 small investment properties, loans that are 60 or 50 grand a piece, or they pay off a couple vehicle loans because the effective interest rate on the all-in-one, although the rate is 8, the effective interest rate might be 2, and they might be paying 6% on vehicle rates, right? So mathematically, it would pencil. I met with a guy yesterday who had a rate of 6% and his payment's $1,000 a month. And by adding that balance to an investment property that was free and clear, lowered the payment to like $300 a month. And then the extra $7 goes directly towards principal. And then coincidentally, not a tax professional, so consult your tax guys on this, but coincidentally, that debt that's now wrapped into a loan on the investment property, the interest associated with that is no longer associated with the car. The interest associated with that is now the investment property. So you've got a tax write-off. Again, consult your tax person on all tax stuff. So there's so many different ways to kind of twist and cater this loan to exactly whatever it is that you need. But it really is the best. I mean, optionality is a word I use a lot. It's a great vehicle, right? There's so many different strategies. I've talked to Nino about this on my personal home. I bought off way more than I probably ever should have. But when I bought my personal home, I had a $1.7 million loan. And part of the reason why I felt comfortable doing that is because of the way interest is calculated on the loan. I knew that I wasn't going to be in a bad spot because I wasn't going to pay anywhere near the interest that had I done a 30-year loan. And I rapidly paid down my mortgage to like about $1 million. And then it was like a light bulb went off and I was like, what am I doing? Like, why am I paying off my house so fast? Now, this was just for me. Now, some people, that's what they want,
sure.
Right? But for me, I looked at it and I was like, wait a minute, if I inherited $1 million today, am I paying off my mortgage? And when I honestly answered that question as no, but then I'm like, why am I doing this? So basically what I did is I kind of pivoted the way that I look at my own situation. And every time I'm now utilizing my money to help grow cash flow, because my cash flow is more significant than the debt. And then I'm not married to that decision. I can always pivot anytime I want to and start paying more money down towards the mortgage if I choose to. But, bought a vehicle last week and I just wrote a check from the all-in-one, right? Because I know that my effective interest rate is going to be sub 2% based on my cash flow and my situation. So there's so many different unique applications to make this loan work, whether it's you wanting to use it for investment strategies or whether it's, you know what, I want to pump all my money into my loan and pay my loan off as fast as possible. We also have an accumulation that, for those of you who have maybe messed or seen our simulation, you can run a financial simulation, and we've added a wealth accumulation tab on that now to where you can say, okay,
I didn't know that.
We did, yeah. Cool. So if you pay off the house in 5 years, right, it'll say, okay, great. In month 60, we pay it off, but let's presume that we continue to pile the same amount of money we always have, not into the loan anymore because it's zero. And let's do that for the next 25 years. So they'll compare a side-by-side of what happens over the next 30 years. And it takes into consideration the potential appreciation of the home, which you can manually input. I think it's defaulted to 3%, but you could say, hey, let's say the home only appreciates at 2% a year. And then you can say, what if I earn the average S&P 500 return, which is like 10% over the last 30 years? You could throw that in there, and it actually shows you how much not only did you pay off your house in 5 years, but over the course of 30 years, you paid off the house and accumulated millions of dollars in investment. And the idea is just to kind of open people's ideas, not necessarily to tell them how to use the money, because obviously there's tons of different strategies on how to best utilize the money on, whether it's life policies, real estate, all the above, maybe even some traditional investing. I think there's hundreds and hundreds of different kinds of options out there, but the all-in-one gives you the options to kind of maximize the efficiency of all of it, in my opinion.
For sure. No, and something that I was curious about, because I mean, you've packed in a lot there. There is so many strategies, so many went through my mind, and that wealth calculator, that seems really cool because it gives you a side by side of what you would be spending versus for the all-in-one compared to a traditional mortgage. So that gave me kind of an idea. So what if, because Pei and I and what we recommend is all about cash flow, right? We want to park money, pull it out, invest it. Park money, pull it out, and invest it. Make it, of course, assuming that the investment that we're going into is paying more than the interest we're saving from the all, right? If that's not the case, then we're going to turn that, like you said with the car, if the car interest is going to be higher than I can get from an investment vehicle, well, I'm going to park that money in the all-in-one and pay my car off from the all-in-one as opposed to the investment vehicle. But let's assume, for simplicity's sake, that we're putting money in, flow our cash flow in, take it back out, put it into investment. If the all-in-one is always tapped out, basically, never really refilled, what's the monthly payment going to be? Is it an interest-only payment or is it amortized?
Yep, it's interest only in that situation. So if your interest rate is 8, you literally times it by. Well, I mean, that's a loaded question technically, because you're going to have, even if the money's tapped out, you're still flowing money through it.
Correct.
Right?
Even for a day.
Right. If your W-2 money is going to set it in there, but for simplicity, when someone says, "What's my payment?"
Yeah,
I don't account for all the monthly cash flow. I just go, okay, your loan amount times your interest rate divided by 365 times the amount of days in the month. That's the rate, right? Or for simplicity, loan amount times interest rate divided by 12. Okay. That's the payment. Technically, the payment's going to be less than that because your cash flow as an interest, it's going to offset. But for simplicity, I'll just kind of round up. Okay, this is what your payment's going to be. But yeah, it's an interest-only payment. It's interest only for the first 10 years. And then what happens? Yeah, after year 10, the line of credit actually starts to decrease by 1/240th. Yep. So for a $240,000 loan, after year 10, month 1, right? So month 121, the line of credit would be $239,000, right? It would start to decrease by 1/240th for the last 20 years of the loan.
So would it be feasible to, and I'm not saying this is a recommended strategy, just kind of curious, would it be recommended to buy a home with the all-in-one or turn your home into an all-in-one, live there for 5 years using all that cash flow that you're getting in and out? Because again, you're still paying that down, whether you're trying to be intentional about it or not, assuming you're just using your cash flow. But if you get paid on a Monday and you don't fund your investment until Friday, well, you have 4 days of the money sitting in the all-in-one. That's naturally going to reduce your principal. But let's say we just use that money to consistently as a flow through entity. And after every 5 years, 5 to 7 years, which is what the traditional American does, right, is move. So could I then basically, if I wanted to strategize it correctly, sell that home, then get an all-in-one on the new home and just do this indefinitely until I'm gone and just pay interest only?
Yeah, you certainly could. Yeah, I mean, in that situation, you technically wouldn't be paying interest only because your cash, your lump sum deposits that are moving in and out are going to be so large, they will be noticeable. But yeah, no, in theory, you could do that. The idea, I'll give you an example on mine. When I got my balance down to $1 million, I looked at it like, okay, I can either keep doing this or I can accelerate my investments, right? Mm-hmm. So not only could I potentially, so for me, I read the numbers based on my numbers are hard to predict because I'm, a lot of people probably listen to this I'm commission based, or if you're self-employed, your commissions, your income's up and down, right? So I tried to just do it based on averages, right? So in my situation, if I just basically keep my balance more or less as an interest only for now and just continue to invest, I penciled it out in year 8. If I wanted to, I can eliminate the mortgage to 0, and I've got cash flow going and other investments going in addition to that. So for me, I think that there's a lot of, part of that just is personal appetite, comfort level. I think as someone gets more entrenched in investing and more comfortable with it, they start to realize, hey, you know what, this actually makes sense to treat this more as an interest only. But that's not necessarily, a forced attribute. You can do whatever you want with it, right? But I have noticed that a lot of times people get introduced to the concept and they're pretty conservative to start with. Uh-huh. And then 2 or 3 years in, they're like, wow, I really get this now. And they start to see the options available to access the cash for income producing activities, whether it's monthly cash flow or whether it's play on equity or whether it's a tax play, using that cash flow. I mean, using the money to purchase into an investment vehicle that also has some tax strategy benefits can also really make those numbers accelerate quickly as well, right? So yeah, I mean, that's personally my take on it. It wasn't for a long time. Mine was paid down mortgage, paid down mortgage, paid down mortgage. And then I kind of pivoted and was like, all right, let's get a little more heavy on the investment strategies to increase cash flow and long-term holdings as well.
Well, I think you touch on such a good point. Something that we talk about on this podcast is identifying the big goal and the big outcome, right? Because people will say, there's 2 camps, right? You might have people who say, I'm going to do whatever I can to pay my mortgage off just as fast as I can because I don't want to have that mortgage. And we like to ask why, because there's a money belief that goes on behind that. It's a safety blanket that, okay, I need to have X amount of cash liquid, or I want to have my house paid off. But what is that solving for you as an individual? Is it strictly a safety blanket? Or do you feel that you've been taught since, you follow Dave Ramsey, you've learned these different strategies that I need to save instead of invest? So the sooner you can identify your investment strategy, the sooner you can identify what your goal is. And if your ultimate goal is, I want my cash flow to be so high that it can cover my expenses and I can reinvest the rest, well, that's your goal. And you can put a number to that I want $5,000 a month, or I want $10,000 a month that I want to live off for my lifestyle. Then you can pivot and use the all-in-one strategy correctly based on your current goal, but also knowing that your goal might change, right? You might be at a certain place now, but then in 5 years, your money's just coming in from all over the place and you realize, I'm okay with my money just parked in the house right now in the mortgage. I'm still saving money because I'm not paying that money in interest, but I just have that money saved up for an emergency fund. And I think that is between, for me personally, and I know with Pei as well, the 3 pillars, in my opinion, to what has been a success for us individually has been the infinite banking concept, the income snowball, and the all-in-one. And we'll dive into, obviously we're doing the all-in-one strategy right now, but we'll dive into each of these 3, in further podcasts. But when you combine these 3, I mean, you've already touched on it, you being an income snowballer as well. When you really throw all these 3 in together, what you can accomplish in terms of cash flow on a monthly basis is just insane. Am I right, Pei? I mean, it's crazy.
And actually, I was going to ask Adam, is there a tool available to the borrower that kind of we can tool around I know that, when we first reach out to you, there's like a calculator on the website that's available for people to kind of plug in their numbers.
Yeah, I can show you that real quick. Do you want me to show you that? Would that be a good time?
Please. Yeah.
So let's do that real quick. Let me just kind of share my screen and I'll do that real quick. You've got to enable sharing for me real quick,
We're gonna end it with a bang, and we're gonna just show people why this thing is so
worth 1,000 words.
Yeah, for sure. Well, and also too, you talk about mindset. Did you enable it for me, Nino?
I'm doing it right now.
Okay.
This is the fun part. I remember doing this. This was probably, Adam, you and I had our first conversation probably about 18 months ago. I remember doing this and seeing these numbers and just, because at this time, it was strictly if I used my cash flow to just pay down the house. I remember, and I had bought an investment property that was like $150,000. I remember, Adam, you had told me, you're like, if you use all your cash flow, you'll pay this house off in 9 months. I remember.
Yeah, I'm gonna give you an example. Actually, I have this one saved from yesterday from a client. So I'm gonna walk you through kind of a rough shot scenario of this particular individual situation. Okay. So they have 2 homes that they have for $120,000 balances on 2 investment properties. Now, the conversation I was having with this particular client is he had a property that's free and clear that is worth $280, right? So $280. Let me just do this real quick. Oops. So the client situation is he has a free and clear property. I explained to him you can't draw from the free and clear property because the loan doesn't allow it unless you have a need for it, right? So in this situation, we said, okay, investment property, 70%, he has $196,000 available. But in this guy's situation, he also has $200,000 in cash, setting in checking and savings. So the guy has $396,000. So check this out. I said, let's pay off the $220,000 loans. And I did, gosh dang, I put this on the screen. I'm going to scratch that and put it back. I'm looking at my top screen and not this. Okay, so
All good.
I'm going to kind of start over with that concept real quick. All right, so I'm going to use the example of a client that I met with yesterday.
It's still not shared.
I'm not sharing anything.
I have the one where it shows 2.8 years on the left side and the 30 years.
Okay, you see that. Okay, so I'm going to drag this down. So this example that I have on the screen is actually a client consultation I did yesterday. So obviously I'm not going to say any names, but I'll just give you an example of his scenario. In his situation, I'm just going to kind of briefly go over what his scenario was. He has $200,000 sitting in checking and savings, fair amount. He also has a $280,000 home free and clear. At 70%, that means he could have $196,000 access to equity. So I'm going to add the $200,000 that he has in checking and savings at $396,000. He owes $120,000 on one of his investment properties. He also owns another $120,000 on another investment property, and he owes $50,000 on a vehicle with $1,000 a month payment. So in this situation, he could pay off both of those properties. He could pay off both of the properties and the vehicle and still retain $106,000 access to cash because he liked the idea of having the peace of mind. But in the long run of it, he essentially, if you look at it from this standpoint, 120 is what he owes on the house plus 120 plus the 50 grand. It's 290 in debt. Right now, he's $290,000 in debt. He takes the $200,000 that he has sitting in checking and savings. Again, keep in mind, still has $100,000 access to credit. But once he deposits that 200 grand against this new all-in-one that he created, he's now paying interest on both homes and the vehicle, a total of $90,000 in debt because he's using his cash flow to offset his interest. Does that make sense?
Yep.
So essentially, his numbers end up being $90,000. I'm going to go ahead and actually adjust this. So here's his setup right here. We didn't have anything to compare it to, so I just did an example. So this is the all-in-one simulator page right here. And I think, Nino, I've supplied you with the link on this. So anybody that wants to do this, I would recommend not necessarily doing it on your own.
For sure.
Go ahead and do that, but I would like to walk you through it. For anybody watching this, I'm happy to do a consultation, kind of walk you through it, because a lot of times people overlook or run the numbers different.
No, this guy's. I tried doing this myself, and
well, there's a lot of things to account for. But in this situation, get the setup here. $196,000 balance. I'm comparing this to a 30-year loan at 7.25 cash out. That's actually lower than what investment interest rates are at the moment on a cash out conventional. Mm-hmm. But to be conservative and to compare the loan to something conservative, this is what I'm using. And then in this guy's situation, he has about $15,000 a month coming in. I'm going to put the $200,000 that he has in checking and savings. The reason I said $1 when I just had it is because we ran an example where I took the 200 grand out. What happens if we don't 200 grand? So when you saw the 200 or the 2.8 year payoff, that's with him not having a 200 grand.
Oh, wow.
Hand. Yep. And then what's next? Actually, we go back to deposits. I also have repeat deposits. In his situation, he had $5,000 a month from his 4 rental properties total. The 2 that we just paid off, one that he also has a small loan on, and then the one that's free and clear.
That's in addition to his $15,000 a month cash flow.
Correct. Yep. And the $5,000 is not net. That's right. That's after management fees, but before mortgage payments, right?
Okay.
And then in his situation, coincidentally, by doing this, paying off the vehicle, he was cash flowing about $3,000 a month. But by doing this, paying off the other 2 vehicles, the other 2 homes and the 1 vehicle, his cash flow went up another $2,000 a month. So his cash flow coincidentally ends up being 5% or $5,000, which is 25%. So in this situation, this is how the all-in-one for him would pencil out if he piled all of his money into his loan. Pays it off in like no time, right? But the idea and concept is, let me go back and get rid of the deposits. What I did for him, I said, let's go ahead and just put this as a $1 deposit. Let's assume that we don't put that extra money in there. And we've got this 2.8 year. This is ultimately where we left off with him. But check this out. Based on the paydown summary of this particular individual's cash flow, their effective interest rate is less than 1, comparing it to 7.25. And the all-in-one is a variable rate loan. And the interest would have to go to, the break-even average, the interest rate would have to go to 33.017% before it's the equivalent of the 7.25 he's paying.
And part of this is because it's amortized versus interest or simple interest, correct?
Yeah, and it's not just because it's simple interest, it's because the sweep feature allows you to offset your interest with your cash flow, right?
I see.
Because it's the cash flow in that situation. In this particular guy's situation, he has $20,000 rolling through his account every single month. Right. And so I think it's a good example. Take your monthly cash flow, times it by 60 months. Over the course of 5 years, there's 1.2 million flowing through the account. And while that money is waiting to be spent, in this situation, you had 20 grand coming in. There's 15 grand going out just to live life, pay bills. Right. Well, that 15 grand, while it's waiting to be spent, is powerful too, because that 15,000, just the money he spends times 60 months, that's 900 grand.
And something
the loan allows you to capture that money while you're waiting to spend it. It allows you to offset the interest while it's waiting to go out the door. Most people think of, okay, I've got lump sum money, I've got leftover cash flow. That's what drives the all-in-one, and it does. But the also driving factor is the money that you spend while it's waiting to be spent allows you to offset interest, and that's powerful over an extended period of time.
I want to touch on this because Pei was, this is the one this is what I learned from Pei. I remember when I first started talking to her about this, it was get paid the first week of the month and set all of your credit card bills and all of your bills to be due at the end of the month. That way you have at least 3 weeks of that sweep feature where you're parking that money in, where you can even maximize this even more. Right, Pei?
Oh yeah. I see my dollars as my employees, right? If I'm the boss of my employees, do I want my dollars sitting in the lounge, smoking and joking and not working? No, they get to work right away.
I'm still in that Pei. I'm going to use that line. I love that. Yeah, it's true. It allows you to put your money to work, and it's constantly at work. If you don't have an investment vehicle to put the money in, while you're waiting to decide what to do with it, it's sitting in the form of offsetting interest, and it's going to work. And it's going to
should be doing.
It's going to form offset interest. And on that line of thought, think about this real quick. 8%. I'm going to pull this up real quick. Let's just say you got 100 grand at 8%. Well, if you're a high income earner, you don't pay taxes on the 8,000 because it's classified as savings. In order to get that kind of return on 100 grand, if you're a high income earner and your tax bracket's 40% plus 40%, you'd have to have an 11.2% rate of return in a traditional investment after taxes to get what has zero risk by placing it into the all-in-one, right? So it really can be powerful. There's a lot of situations where, I've seen so many situations where people have hundreds of thousands of dollars sitting in low yield or no yield investment accounts. I had a borrower once that had $1 million in a checking account. And I was just like, holy smokes.
That's Pei's worst nightmare.
What a lost opportunity, right?
Yeah.
And here's a pay down graph you can see in this situation. The blue line represents the all-in-one limit. The green line represents the traditional 30-year mortgage, and the black represents the all-in-one. In this situation, let's just go to week 372. Balance is zero. The traditional mortgage balance would have been 179, and you could write a check for $196,000. And so one of the natural things that people say is, well, couldn't I just accomplish the same thing by putting extra money into my mortgage? And the answer is yes, but you would lose all availability to the cash because you can't get to it again unless you sell the property or refinance it. The all-in-one allows you to pay down the home rapidly, use it for investment strategies, whatever you want, because you have access to the cash. Every dollar you deposit towards equity is available to you, right? The interest, a lot of times people think of a variable interest rate loan as risky.
Sure.
And I'm not going to completely disagree with that, but to think that a 30-year mortgage is risk-free is just faulty thinking. The risk is just predetermined. It's predetermined in front-loaded interest.
Yeah. Well,
right. It's a front-loaded instrument. If you were to go and do an amortization calculator today and just say 7% rate, $300,000, if you follow the amortization calculator, if you were to just Google that term, in fact, I'll just do it if you don't mind.
Go for it. Yeah.
I want to just.
This is all about control too, right? As an IBC practitioner, we always teach people about regaining control of your dollars. And having that all-in-one, we're still using banks. We're not saying banks that we don't want to work with banks at all. We want to be banking smarter and having control of our dollars. If we were just to dump all our cash into a traditional home equity, the banks are happy. Thank you so much. You're giving us the money. You're basically de-leveling their risk, right? The more you pay down your mortgage, the less exposure they have. They love it. And then you're giving them the money to go out and make more money on your money. So this is way better than
along the lines pay of a traditional bank too. It's good to point out too. Let's just say you did have a $250,000 mortgage and you accumulated $250,000 worth of cash and you had a zero balance. The FDIC insurance part doesn't even kick in until you accumulate another $250,000 above and beyond zero to where you have a credit balance, right? So it also turns it into a place to safely keep more than the minimum FDIC insured amount. Does that make sense?
Mm-hmm. Yeah.
Because normally, in order to, if somebody has $1 million, they got to divide that up into 4 different accounts to keep it FDIC insured, right? With the all-in-one, if you had $1 million of loan, you could piled against the balance, still have access to it, and it's all protected and another $250,000 from an FDIC standpoint. But back to this point about the amortization, 30-year loan is considered safe and risk-free, right? But if you look at it, 30-year loan, 7% interest, $300,000, you don't get down to a 50% interest and 50% principal payment until right around 21, 22 years. So you're front loaded on interest for the first 22 years of the loan. And that's a lot of dough. And you can see right here, the way the interest calculates on this loan, total interest paid on a $300,000 loan is $418,000. So between principal and interest, they end up paying $718,000. The all-in-one just completely flips the script on the way interest is calculated. And in comparison to a 30-year loan, this consumer potentially saves $262,000 in interest costs. And then
Not
back to
even
that
factoring in what they could do with that money in the meantime.
Sure.
It could easily be double that, easily.
Yeah. And if someone wants to go ultra conservative, you go, hey, look, let's just pay it off 2.8. Maybe you've got your spouse is a worry wart and won't take the time to really kind of understand the investment strategy. And so I see that a lot, right? Where one spouse, whether it's the husband or the wife, is really gung-ho about investing. The other one's super nervous, and maybe you do a little bit of a hybrid of the two, or maybe you go, you know what, let's just pay off the mortgage super fast and then accelerate our investing. I would wager that that's probably a backwards way of doing it. I think that you do the investing simultaneously is the way to go. But here's the wealth accumulation tab. So in this situation, I'm actually going to go in and change this scenario real quick. Let me change the spending down to even less. Let's say 10% left over at the end of a calendar month. So we've got a 5.8 year payoff, still save an absolute boatload of money. And the effective interest rate is north of 1 now. It's 1.38. Okay. Now let's go to the wealth accumulation tab. The idea here is you pay off the loan in 70 months. Well, what happens if you continue to invest those same dollars for the entire term of the loan of what you would have done 30-year loan? All right. You've got, let's just say let's say the home appreciation is 2, which is, I think, conservative. And let's say the rate of return was 10, which I think the S&P 500 for 30 years is close to 10, right? And I think you can do better than that if you.
Oh yeah, we'll name drop Panda here.
Yeah, 100%. But you update the results. Not only did you pay off the home in 30 years, but the home that was 280 is now worth 507. Oh. And in addition to the home being paid off free and clear, you also have $1.6 million in an investment account. And you've got a 2 point. I mean, it changes the game because now it's not just a mortgage, it's an investment vehicle.
Wow.
That's so powerful.
Wow. Yeah. This really is such a cool calculator.
It really is. This is a new enhancement. The CMG has a lot of people behind the scenes that make this work. Dave Herbst is the vice president of the program, and he's kind of the wheels that make this thing really run internally. This is something he's been pushing for a long time, and they've made it happen. And it really is a very cool tool. This loan is amazing, guys. It's again not the right fit for everybody, and there's situations where I'll do consults and I recommend, I probably wouldn't do this.
What are the situations if you can give us just
it's usually when there's low cash flow, right? For the snowballers that I get and their flip size is $7,000 or they're just starting out, right? There's really not enough cash flow to really drive the all-in-one balance down rapidly, or especially to justify going from a 3.25 or whatever to an 8, right? If there's no cash flow to really offset interest, all they've really done is actually set themselves backwards on their snowball, right? So we got to evaluate those situations carefully. And sometimes I'm recommending people, hey, let's do a little bit of a midterm hack. Let's do maybe a second position from equity line of credit so you can utilize the concept. There's a lot more manual application that has to take place. You've really got to manage the dollars and shuffle it, all manually. I love the all-in-one because it sweeps, right? I'm a little bit lazy in that regard. I like to just put my money in and have it go automatic, right? That was the same thing for me originally on my investing. I was doing some of the social lending club type stuff, and it was very tedious to do the investments. I'm like, I can't do this anymore. I'm going to just put this in a place that's going to give me a rate of return that I can do. I'll dump it all in as a lump sum. To me, the time back was worth the slightly lesser rate of return, right? Because I didn't want to have to be constantly dealing with it. I'd rather spend my extra time learning about a new strategy than I would be actually implementing the strategy to start with.
Yep.
So,
moving out of Texas then.
Yeah.
This fits you so well. Man, Adam, this is I love the calculator just in general, but I love the fact that you're able to, and I mentioned this before in one of my primary residents, my prior one, I had met with you, we had discussed it, and the numbers actually didn't work at one point because I wanted to do a different strategy, and I really liked how transparent you were to showing the numbers and straight out telling me, maybe you shouldn't do this right now. Maybe it's not going to work because overall with your cash flow, it might not be best. And the fact that at the end of the day, of course, you're still selling a mortgage, but to be able to be willing to just say, hey, this isn't the right product for you at this moment, I think for me is huge because it just shows that you're not trying to make a sale. You're about educating the individual that you're speaking with, which goes way, way further for me personally. And I know Pei's had that experience and many others who have spoken with you. So just to kind of sum everything up, because that last part just blew my mind. Again, it's one thing talking about concepts, but when you put things onto paper and you see the numbers, I mean, you see that $2 million of what you would have accomplished in 30 years compared to if you would have just paid down your mortgage like you normally would have. That wealth calculator sums it up so well. But with this all-in-one calculator, this all-in-one product, it's so unique, so interesting, such a powerful tool that when used correctly, even with just your guidance, Adam, people are going to be in a better position than they were if they didn't use the all-in-one in general. But then you combine that with other investment strategies that we've discussed or are going to be discussing, and this can be a fundamental piece of your foundation to really improve your overall cash flow. But more importantly, like we discussed, is improving your overall lifestyle. And I can't thank you, Adam, enough for sharing this with us, for sharing this opportunity. I know that it's not on, you don't go on social media and see all these different hacks. You hear people about, you either hear the Dave Ramsey's telling you pay off your house and keep that cash, or you hear the opposite, don't ever buy a home and just rent because the market and it's all bad. But this is kind of a hybrid of the benefits of home ownership, of using this effective strategy. And like I said, I can't thank you enough. Could you tell everybody where we'll post your link to the website, sure, but how people can get a hold of you if they want to sit down and go over their situation?
Yeah, obviously anybody that knows that this is a good fit for them, more than happy to fill out an application. Send me an email though. My assistant Stacy does a great job. She'll reach out to you directly if you make a request to meet with me. She'll schedule something, put it on the calendar. I'm happy to do a consultation with anybody and everybody that wants to kind of go through a review on this. And my approach really is exactly what you said. It's, when someone comes and talks to me, I like to think of it that I like to think that I handle every transaction with, okay, what would I do if my brother came to me or my sister came to me and they explained the financial circumstances to exactly what the client's saying? What kind of advice would I give? I like to have that be my general guide so that I'm true to a specific standard, because I'm planting my flag in this industry. I'm not this guy behind a call center, no disrespect to, Rocket Mortgage or anything like that. But, this is me, right? I'm putting my family out there. My social media is not a lot of business stuff. It's personal stuff and my family. And I planted my flag in this industry, and I have no interest in doing a loan for somebody to collect a commission and have them feel bad about it afterwards. There's no reward in that for me. And I've been very blessed in this industry. I've been in the top 1% of mortgage originators for the last 6-7 years. I've been in the top 5 in all-in-one production nationally for that same period of time. And I'm here to try and hopefully have a positive impact on people's lives and their individual family finances. And that's rewarding to me. So if I meet with somebody and the all-in-one's not a good fit, I don't look at that as a waste of time. I genuinely don't, because I know a lot of times I can give tips and tricks or inside ideas that I know will better their situation. And most people that actually will pursue a consultation are genuinely trying to improve their situation, and they'll take advice that's good and they'll implement it. And so I like being a part of that. I find that rewarding. And for me, in this industry, it can't be just all about money. I like to make money and have it be rewarding simultaneously. And the all-in-one allows me to do that because it's such a significantly improvement to the concept of mortgage.
And I can definitely say you've had a huge impact on me personally, and I appreciate that. And just also in general, I can sense your passion every time we talk. You genuinely enjoy doing this, and that makes it so much more pleasurable. So Pei, any final thoughts?
No, I am looking forward to connecting with Adam and getting my financial calculator redone. I did it, I think, two years ago, maybe. But, timing, again, like I said, sometimes it's just timing wasn't right and whatnot, but looking forward to revisit that. And hopefully.
And Pei, if I remember right, my memory might serve me incorrectly, but I remember doing a video with you and Michael, and in the background, I remember seeing Mavericks in the background. You Dallas Mavericks fan?
No, I don't think.
Am I mistaken?
That was probably not me.
Was it Spurs? Where are you at?
I'm in Houston, Texas.
You're in Houston. Okay, so it would have been Rockets then.
No, I think that maybe somebody else, but
is it? Okay.
Yeah.
They're not playing sports.
Nino, where are you at in Texas? I can't remember.
I'm in Houston. I'm about an hour northeast of Pei.
You're both there. Okay.
Yeah, so I always see her. Thank
Yeah,
goodness.
I've only been to Houston one time. Guys, I appreciate it. I appreciate the opportunity. I appreciate everything you guys are doing, helping people grow and improve their financial situation. There's so many people that are hungry to improve their situation. They just don't know how. And what you guys are doing is awesome. So keep up the good work.
Appreciate it, Adam. Everybody, thanks again for joining in, and stay tuned for further episodes. Take care.